So in the middle of this absolutely massive artificial intelligence gold rush we're seeing right now, I think there is a very simple and honestly very dangerous assumption driving the market.
Oh, 100%.
Yeah.
Everybody is throwing, just absolute billions of dollars at whoever's building the smartest AI models.
Right. The whole narrative is that the companies forging the sharpest cognitive pickaxes are just going to win the entire era.
Yeah.
But what if the real durable fortunes actually belong to the companies building the toll booths? What if the real money is in the security checkpoints, the infrastructure, and the compliance layers that actually allow a massive regulated enterprise to use that AI without, violating the law or leaking their own secrets?
Yeah, and it is a question that completely upends the current hype cycle. I mean, we are seeing this massive disconnect between what looks flashy on a demo screen and what a Fortune 500 bank or, say, a national defense ministry will actually allow onto their secure network.
Exactly.
Because the underlying models are becoming commoditized. But the ability to safely integrate those models into a 20-year-old legacy communication system, that is highly specialized, incredibly difficult engineering.
And that tension is exactly what we are dissecting today. So welcome to this special Talk Tickers edition of The Deep Dive. Our mission today is highly specific, and it is entirely for you, the retail investor, trying to cut through all this noise.
Right.
We have a stack of sources centered around one specific, really fascinating document, which is the Q4 and full year 2025 earnings call transcript for AudioCodes. The ticker symbol is AUDC.
AUDC, right.
And our goal is to take the Wall Street jargon, all the financial maneuvering, and that dense corporate speak in this transcript, and break it down into actionable, plain language insights. We're going to look at what they brought in, what they spent, what management is promising for the future, and ultimately what it means for anyone holding the stock or thinking about taking a position. Okay, let's unpack this.
AudioCodes is just the perfect case study for this exact moment in the tech sector. I mean, this transcript isn't just a routine quarterly update. It is a live, real-time look at the architecture of a massive corporate transition.
Yeah.
We are watching a legacy hardware connectivity company attempt to execute a highly complex, incredibly expensive pivot toward a modern AI-driven software model. And, pivots like this are historically brutal. They are the graveyards of the tech sector.
Oh, totally. Which is why we need to start with the reality of what the market saw when the numbers crossed the financial terminal wires. We need to look at the headline numbers, because if you just glance at the top-level data without the context, you might be tempted to hit the sell button immediately.
Oh, absolutely. The knee-jerk reaction would be panic.
So let's look at the revenue first. For the fourth quarter of 2025, AudioCodes reported top-line revenue of $62.6 million.
Okay.
And if we compare that year over year to the fourth quarter of 2024, that is a 1.7% increase. Looking at the full year of 2025, total revenue landed at $245.6 million, which is up 1.4%.
Right. And those revenue numbers tell a very specific story about macroeconomic survival.
How so?
Well, in the enterprise technology space, a 1.4% annual growth rate is not going to capture the attention of growth-obsessed venture capitalists, right? Yeah. But context is everything. Over the last 2 years, corporate IT budgets have been under severe pressure. We've seen elevated interest rates making capital expensive.
Yeah, nobody wants to spend money right now.
Exactly. Companies have been delaying massive hardware overhauls, just trying to squeeze another year or two out of their existing infrastructure. So for a company whose historical bread and butter has been selling physical network hardware, posting slightly positive revenue growth means they have successfully defended their turf. The top line is stable.
Right. The foundation is not cracking. I hear that. And stability is great, but then we hit the sticking point. The number that absolutely jumps off the page and screams danger to a casual investor. We need to talk about their net income, specifically their earnings per share or EPS.
Yeah, this is the rough part.
It really is. For the fourth quarter of 2025, their non-GAAP EPS came in at $0.16. That is less than half of what it was in the exact same quarter a year ago, which was $0.37.
Right.
And the full year picture isn't much better. Full year EPS for 2025 was $0.61, which is down severely from $0.87 in 2024.
And that is the exact friction point that defines this entire earnings call. What's fascinating here is that if you're an investor looking at a stock screener and you see earnings per share plummet by more than 50% in a single quarter while revenue remains flat, well, the traditional algorithmic response is that the business model is failing.
Yeah, my immediate instinct is that they are having to discount their products massively just to keep that $245 million revenue number stable. Like, it looks like they are buying their own top-line stability by sacrificing their profit margin.
That is the logical assumption. But it's precisely why we have to dig into the transcript to see the actual mechanics behind the numbers. Because when you listen to the tone of the CEO and the chief financial officer on this call, there is zero panic regarding that EPS drop.
Wait, really? No panic at all?
None. They aren't making excuses for it. They explicitly stated that the $1.16 fourth quarter EPS was entirely in line with their internal premeditated plans. This was an engineered compression of profitability.
I need to stop you there because my brain is flashing red flags.
Fair enough.
If I'm a retail investor and I see a company's profits drop by half and management says, oh, don't worry, we plan to make less money, how do I differentiate between a company that is fundamentally falling apart and a company that is just executing a strategic pivot? Like, how do I know they aren't just spinning bad news?
You look at the gross margin. The gross margin is the absolute lie detector test for a hardware and software company.
Right.
It tells you the fundamental economics of the product they are selling before you account for the corporate overhead, the research, or the marketing.
Okay, let's define that clearly for the listener. When we talk about gross margin, we are talking about the revenue they bring in from selling a product, minus the direct, unavoidable costs of actually creating that specific product. So the cost of the raw materials, the manufacturing, the direct labor on the assembly line, or, the server hosting costs for their software.
Precisely. If a company is losing its competitive edge, or if it is being forced to slash prices to maintain market share, the gross margin will collapse. It means it is costing them the same amount to build the product, but they are getting paid less for it.
Makes sense.
But that is not what happened with AudioCodes. Their non-GAAP gross margin for 2025 held remarkably steady at 65.9%.
And management noted on the call that their long-term target zone for gross margin is between 65% and 68%. So they are sitting right inside their historical comfort zone.
This is the crucial takeaway. The fundamental economic viability of what they sell has not deteriorated at all. They are still commanding the same premium for their technology in the marketplace. The cost of producing their goods hasn't spiraled out of control.
So where's the money going?
The issue is entirely located further down the income statement in the operating margin.
Okay, let's look at the operating margin. This is where you factor in all the other costs of running the business, the research and development, the sales team's commissions, the marketing campaigns, the administrative staff. And the transcript shows that their operating income dropped to 8.6% of total revenues.
Right.
That is a significant fall from 12.1% a year ago.
And that gap, the difference between a rock-solid gross margin of 65.9% and a shrinking operating margin at 8.6%. That is the entire thesis of this investment. It proves that the core business isn't broken. Rather, management is taking the cash generated by the core business and aggressively spending it on new internal initiatives.
Okay, to translate this Wall Street accounting reality into something tangible, think of it like remodeling a highly successful traditional diner in your neighborhood.
Ooh, I like this.
Let's say you own a diner that has been serving the exact same reliable burgers and fries for 30 years. You know the neighborhood inside and out. That is your legacy business. But you look down the street and you realize the demographics are shifting.
Right, tastes are changing.
Exactly. The future isn't burgers. The future is high-end, automated, AI-driven sushi. You know you need to adapt. So you decide to build a state-of-the-art sushi bar attached directly to the back of your existing diner.
This is a great framework. Let's apply the financial metrics to this diner.
So you keep the front doors of the diner open during construction. Your regulars are still coming in every single day, buying their usual meals. Because of this, your top-line revenue is steady. It's holding firm around that $245 million mark.
Yep.
And the cost of your ground beef, your potatoes, and the cooks on the grill hasn't skyrocketed, which means your gross margin is perfectly fine. You are still making a healthy profit on every individual burger you sell.
But when you sit down at the end of the year to look at your overall bank account, your total net income has cratered.
Exactly. Your profits have vanished. Why? Because out the back door, you are actively paying a massive crew of specialized architects, high-end construction workers, and expensive sushi chefs to build and design this entirely new wing of the restaurant. You haven't suddenly forgotten how to run a profitable business. You are making a deliberate, calculated choice to take the cash flow from the burgers and funnel it directly into the construction of the sushi bar. You are enduring short-term financial pain to build a brand new engine for long-term growth.
And that is exactly what investors need to understand about that $1.16 EPS.
Yeah.
It isn't a failure of the legacy business. It is the cost of the construction crew for the new AI business.
Right.
To really demystify how this is playing out internally, we need to look at how management is separating the company into two distinct segments. Because if you are going to invest in AudioCodes, you have to evaluate these two segments completely differently. They have entirely different risk profiles and growth trajectories.
So let's look at the first segment, which we can think of as the legacy connectivity business.
The traditional diner.
Yes, the diner. This segment still represents a massive 93% of their total overall revenue.
It's huge.
Yeah. And when we talk about legacy connectivity, we are talking about the physical and virtual plumbing of enterprise telecommunications. We're talking about session border controllers or SBCs, voice gateways, and the routers that allow massive companies to connect their internal phone networks to the outside world over the internet.
Let's pause and actually explain what a session border controller is. Because it sounds incredibly dry, but it is the absolute bedrock of how modern business communication functions.
It really is.
If I'm a massive multinational bank and I have 50,000 employees using internal phones, I can't just plug that network directly into the public internet.
Yeah.
It would be a catastrophic security vulnerability, and the audio quality would be a chaotic mess.
Right. Think of a session border controller as a highly sophisticated, heavily armed bouncer at the door of an exclusive nightclub. The nightclub is the bank's internal network. The street outside is the public internet. The SBC stands at the door and inspects every single data packet, every single voice call trying to get in or out. It checks the security credentials to prevent denial of service attacks or hackers trying to tap the lines.
It manages the bandwidth too, right? So that the CEO's conference call gets priority over someone downloading a massive file.
Exactly. And crucially, it acts as a universal translator.
The translation aspect is huge. A lot of these massive enterprises have communication systems that were built in like 2010. They use specific telecommunication protocols. But now they want to connect to a modern cloud service that speaks an entirely different digital language.
And the AudioCodes SBC sits right in the middle and translates those protocols in real time so the old hardware can actually talk to the new cloud software without the call dropping.
And that kind of infrastructure is incredibly sticky. And once an enterprise installs an AudioCodes SBC and configures it to handle tens of thousands of daily calls flawlessly, they are loath to rip it out. It is mission-critical plumbing. But, as we noted earlier, this segment faced severe economic headwinds over the last 2 years. In 2023 and 2024, as interest rates spiked and fears of a recession loomed, enterprise IT departments just froze their budgets.
Yeah.
If a hospital or university had an AudioCodes gateway that was 5 years old and they were scheduled to upgrade it to the newest model, they suddenly decided, you know what? The old one is working fine. Let's delay the upgrade for another 2 years to save cash.
Which is absolutely terrifying if you are the CEO of AudioCodes and that specific hardware upgrade cycle accounts for 93% of your income. You are literally watching your core customer base simply stop buying.
It is terrifying, and it's the reason the stock has faced so much pressure. But the most critical piece of news from this 2025 earnings call regarding this 93% legacy bucket is that the bleeding has officially stopped.
Oh, that's huge.
The rate of revenue decline is moderated, and more importantly, in the second half of 2025, they actually saw a stabilization and a slight recovery in customer purchasing behavior. The deferred upgrade cycles are finally starting to thaw.
And even more impressive than just the top-line stabilization is how efficiently they are running this legacy segment. The transcript details that the legacy business delivered a very healthy 14% operating margin in 2025.
Yeah, that's really strong.
And management noted they expect that margin to eventually tick up even higher to somewhere between 16% and 18%.
That margin is the safety net for the entire company. It means that even in a stagnant growth environment, they have figured out how to extract significant cash flow from their existing customer base. They have optimized their supply chain, they understand their sales cycles perfectly, and they are generating reliable profits from the 93% of the business that constitutes the old guard.
So the legacy business is no longer a declining liability that threatens to drag the whole company under. It has stabilized into a cash cow. It is the steady, reliable engine that is actively funding the future.
Which brings us to the future, the second segment.
Right.
The high-end, AI-driven sushi bar being built out back.
The voice AI business. Here's where it gets really interesting because this is what every investor is actually looking at when they pull up this transcript. Right now, this futuristic segment only makes up 7% of their total revenue. It is tiny compared to the legacy plumbing.
Yep.
But Wall Street doesn't value companies based on what they are today. Wall Street values companies based on the trajectory of what they will become tomorrow. And the growth trajectory here is where all the excitement is concentrated.
The transcript reveals that the voice AI segment exited 2025 at an annualized run rate of nearly $17 million.
Okay, let's clarify run rate for the listener, just to be precise. When a company gives a run rate, they are taking the revenue from the most recent period, say the last month or the last quarter, and multiplying it forward to show what the annual revenue would be if that exact pace continued for a full 12 months.
Exactly.
It is a way of showing the current momentum of a fast-growing segment rather than relying on a backward-looking historical average.
Right. So that $17 million run rate represents a 35% growth compared to the previous year. But the momentum is actually accelerating. If you isolate just the second half of 2025, and specifically the fourth quarter, this voice AI segment grew by over 50%.
No, I have to play the skeptic here.
Please do.
When you hear the acronym AI thrown around on an earnings call these days, it is incredibly easy to roll your eyes. The market is completely saturated with it. Every single legacy tech company is suddenly sprinkling generative AI into their press releases like magic fairy dust, hoping to artificially inflate their stock price.
Oh yeah, the AI washing is real.
Exactly. They slap a chatbot interface onto a 10-year-old software program and call it an AI revolution. It is often just vaporware. It is a marketing gimmick with no real underlying product. So how do I know AudioCodes isn't just playing the buzzword game to distract from their flat legacy revenue?
You look at the contracts. Vaporware doesn't generate multi-year, legally binding service agreements with Fortune 500 telecommunications providers.
Good point.
When you dig into the specifics of this transcript, AudioCodes is not talking about theoretical applications of AI. They are putting very specific, highly tangible wins on the board. They are naming the partners, they are detailing the length of the contracts, and they are explaining the exact deployment mechanics.
Okay, let's look at the evidence they presented. The first major proof point from the fourth quarter is a 36-month contract they signed alongside AT&T to support a large public university.
And this deal is a perfect microcosm of their strategy. A large public university is a wildly complex communication environment.
I can only imagine.
You have tens of thousands of students, faculty members across dozens of departments, administrative staff, campus security, and legacy infrastructure, like emergency blue light phones scattered all across the grounds. Historically, this university has relied on an aging, on-premise Cisco phone system. It's clunky, it's expensive to maintain, and it doesn't integrate well with modern remote learning tools.
So the university makes a strategic decision. They want to modernize. They want to move their entire communication infrastructure into the cloud, specifically migrating everything over to Microsoft Teams Voice.
Right.
They want their staff to be able to make external phone calls directly from the Teams application on their laptops, rather than relying on a physical plastic phone on their desk.
But as we discussed earlier with the session border controllers, you cannot just unplug a massive campus from Cisco on a Friday and plug it into Microsoft Teams on a Monday.
Right, that would be a disaster.
It requires an incredibly delicate, phased migration. You have to route the traffic carefully, ensure emergency 911 services still function perfectly during the transition, and manage the underlying network gateways. This is where AudioCodes comes in, partnered with AT&T. They aren't just selling a box, they are selling a 36-month managed service contract to facilitate this massive migration.
And the transcript highlights another massive deal that follows a very similar pattern. They secured a 60-month contract, a full 5-year commitment with an international equipment manufacturer based in Europe.
Wow, yeah. This manufacturer is starting the process by moving 2,000 of their users onto an AudioCodes Live premium managed service. And once again, the underlying goal of the manufacturer is to migrate their legacy voice infrastructure away from Cisco and fully into the Microsoft Teams ecosystem.
And this European deal highlights the absolute genius of the AudioCodes business model right now. They are utilizing a classic Trojan horse strategy.
Walk us through the mechanics of that Trojan horse.
AudioCodes uses their legacy expertise, the Bucket One plumbing, the managed gateways, the complex migration services to get their foot in the door of these massive enterprises. The enterprise views AudioCodes as the trusted, reliable construction crew that is going to safely transport them from the old world of physical phones into the new world of cloud communications.
Right.
AudioCodes embeds themselves deeply into the IT infrastructure of that university or that European manufacturer. They become the entity actively managing every single voice packet that flows in and out of the organization. And once you control the flow of the audio data, you are in the perfect position to upsell the intelligence layer.
Exactly. Once the 60-month migration is underway and AudioCodes is managing all that voice traffic, they can go to the chief information officer and say, hey, we are already handling millions of minutes of your internal and external calls every month. How would you like to apply our proprietary generative AI to that data stream?
That's brilliant.
We can automatically transcribe your calls, analyze the sentiment of your customer service interactions, and provide intelligent meeting summaries, all integrated directly into the infrastructure we just built for you.
They don't have to fight to win a new customer for their AI software. They just have to turn on a new feature for a customer that already trusts them implicitly with their network security.
Exactly.
It drastically lowers the cost of acquiring a new AI customer. And when you look at the total addressable market, the TAM that they are targeting with this strategy, the tailwinds are absolutely staggering. The entire strategy hinges on the explosive growth of the Microsoft Teams ecosystem.
Let's look at the numbers management provided regarding Microsoft Teams, because they are the gravitational center of this entire transition. On the call, management noted that Microsoft Teams currently has 26 million PSTN users.
We threw that acronym out earlier, but let's make sure it's crystal clear. PSTN stands for Public Switched Telephone Network. It is the traditional global telephone system.
Right.
When you use Microsoft Teams to video chat with a coworker who also has Teams, that data stays entirely within Microsoft's cloud. But if you want to use Microsoft Teams as your actual primary business phone, meaning you can dial a traditional 10-digit phone number to call a client's cell phone or a local restaurant's landline, you have to connect your Teams software to the PSTN.
And connecting Teams to the PSTN requires specialized routing, gateways, and security protocols. It requires the exact toll booth infrastructure that AudioCodes builds. Microsoft does not want to be in the business of maintaining physical telecom connections to every local phone carrier on the planet. They rely on certified partners like AudioCodes to handle that last mile of connectivity. So when management says there are 26 million PSTN users on Teams, they're saying there are 26 million people actively paying for the specific type of connectivity that AudioCodes facilitates.
And that 26 million number is up from 20 million just over a year ago. That is a 16% to 17% annual growth rate in the core market that AudioCodes serves. They are riding the slipstream of Microsoft's massive enterprise dominance. But here is the craziest part. 26 million users is essentially nothing compared to the broader potential.
It really is just a drop in the bucket. The transcript estimates that there are currently 320 million active monthly users on Microsoft Teams worldwide.
Oh, wow.
That means less than 10% of the people who use Teams every day are actually using it as a fully integrated phone system connected to the outside world.
The expansion potential is massive. Management pointed out on the call that there's an immediate pre-licensed addressable market of 80 million to 100 million users. These are enterprise employees who already have the appropriate Microsoft licenses paid for by their IT departments. They literally just need the IT administrator to turn the feature on and route the connection through a partner like AudioCodes.
Exactly.
Management expects another 3 million to 4 million of these users to activate PSTN connectivity in 2026 alone. The market is mathematically guaranteed to expand.
But, and this is important, AudioCodes is not just tying its entire corporate chip to the Microsoft mast. They understand the danger of platform dependency. If Microsoft suddenly decides to change its partnership model, AudioCodes will be highly vulnerable.
Absolutely.
To mitigate that risk, they used this earnings call to announce a major expansion into a second ecosystem. They recently unveiled an end-to-end portfolio of certified voice solutions specifically built for Cisco WebEx calling.
And Cisco is the other massive leviathan in the unified communication space. Cisco announced that they now have over 18 million users worldwide actively using WebEx calling.
Right, so by securing certification for both Microsoft Teams and Cisco WebEx, AudioCodes has essentially positioned itself as Switzerland.
I love that analogy.
They are the neutral toll booth and the universal AI upgrade station for the two largest unified communications platforms on the planet. Whether a massive multinational bank decides to standardize their infrastructure on Microsoft or on Cisco, AudioCodes is positioned to be the vital architectural layer sitting underneath, handling the complex connectivity plumbing and injecting the generative AI intelligence.
It is a brilliant strategic positioning. But as an investor, I have to constantly bring this back to the cold, hard reality of the bottom line. Building out that capability for both Microsoft and Cisco and developing the proprietary AI software to sit on top of it is not cheap.
No, it's not.
This brings us back to the restaurant remodel analogy. We need to put specific numerical values on the cost of that construction crew, because that cost is what is currently suppressing the stock price.
The transcript provides a very stark look at exactly how aggressively management is forcing this transition. It all comes down to human capital. AudioCodes has a total global research and development workforce of approximately 350 employees.
Okay.
In what can only be described as a massive, deliberate, and likely culturally jarring shift, management has actively reallocated 150 of those R&D engineers and developers to be entirely 100% focused on the voice AI segment.
Think about the magnitude of that shift. You have a legacy hardware company. You have engineers who have likely spent 15 years meticulously optimizing the silicon architecture and the routing protocols for physical session border controllers.
Right.
And the executive team comes in and says, hey, the market has changed. Almost half of you are no longer working on the hardware that generates 93% of our revenue. You are now being retrained and redeployed to build cloud-based generative AI applications.
The internal friction of a move like that must be immense. I mean, when AudioCodes first started experimenting with this AI journey around 2010, they only had 40 or 50 people assigned to those projects. Now, nearly half of their entire engineering brain trust is dedicated to a segment that currently only produces 7% of the total revenue.
You do not make that kind of radical personnel shift unless you have absolute, unshakable conviction in your product market fit. If management is wrong about the AI demand, they have effectively hollowed out the engineering support for their cash cow legacy business for nothing. It is a massive bet.
It is a massive bet, and it is a bet that is actively burning cash. The CEO was refreshingly transparent about this on the call. He didn't try to hide the cost of this transition in accounting tricks. He stated plainly that the voice AI segment, standing on its own, is currently operating at a cash burn rate of $9 million to $10 million a year. It is deeply unprofitable in its current growth stage.
And there's the missing puzzle piece. That $10 million annual hole perfectly explains the severe drop in the overall company EPS that we agonized over at the beginning of the deep dive.
Yep, there it is. Management is literally taking the reliable 14% operating margin profits generated by the legacy hardware business, and they are shoveling that cash directly into the AI furnace to fuel that 50% fourth quarter growth rate. The EPS didn't drop because the company is failing. The EPS dropped because the company is funding its own reinvention.
But even with all of this context, if AudioCodes was just building another generic AI meeting summarizer to compete with Microsoft Copilot or Zoom's built-in AI, I would be incredibly bearish.
Yeah, you'd get crushed.
Exactly. The big tech monopolies have infinite resources to crush pure-play software startups in the productivity space. However, AudioCodes highlighted a specific micro-trend on this call that changes the entire competitive landscape. It is a dynamic that I found absolutely fascinating, and it is the key differentiator that gives AudioCodes a fighting chance against the tech giants.
You were talking about the counter movement to the cloud?
I am. For the last 10 years, the prevailing narrative in enterprise tech has been that every single piece of data, every single application, and every single server must eventually move to a public cloud provider like Amazon Web Services, Microsoft Azure, or Google Cloud.
Right, the cloud was inevitable.
But AudioCodes is seeing a very specific, highly lucrative pushback against that narrative. They call it cloud repatriation.
Yes, cloud repatriation is the trend of businesses pulling their data and their applications out of the public cloud and moving them back to localized, on-premise servers that they physically control. And the transcript noted a shocking acceleration in this trend.
How fast?
Over the last 2 years, the proportion of enterprise customers demanding to keep their voice users and their communication data strictly on-premise has jumped from 5% to 15%. That is a tripling of demand for localized physical control over network infrastructure.
We have to ask why that is happening, especially when the public cloud is supposedly cheaper and more scalable. And the answer comes down to three things: data sovereignty, privacy regulations, and raw security paranoia.
Exactly. Think about the highly regulated sectors of the global economy: international finance, healthcare, legal services, and crucially, national defense and government intelligence. These sectors are desperate to leverage the incredible productivity gains of generative AI.
Of course they are.
They want an AI to sit in on their meetings, transcribe the dialogue, summarize the action items, and analyze the sentiment of the participants.
But there is a massive catch. If you are a general in a European defense ministry and you are having a highly classified meeting about logistics and troop movements, you absolutely cannot allow the audio of that meeting to be uploaded to an American-owned public cloud server to be processed by a third-party large language model.
No way.
You do not control the security of that external server. You do not know if that data is being stored, analyzed, or secretly used to train a future version of the AI model. The risk of corporate espionage or national security leaks is unacceptably high.
So these highly regulated entities are essentially locked out of the AI revolution because the standard deployment model, sending the data to the cloud, violates their compliance protocols. And this is exactly where AudioCodes saw a massive vulnerability in the market. They utilized their decades of experience building secure, physical, on-premise hardware, and they built a specialized AI solution called MIAOP.
MIAOP stands for Meeting Insights On-Prem. It is a profound piece of engineering. It essentially allows a massive corporation or a government agency to run advanced generative AI meeting summaries and complex communication analytics entirely within their own four walls.
The processing doesn't happen in an Amazon data center. It happens on physical servers sitting in the basement of the defense ministry. The data never traverses the public internet. It never leaves the physical custody of the organization.
That is wild.
AudioCodes provides the software, the orchestration, and the hardware compatibility to make a localized large language model function seamlessly with the organization's existing internal phone network.
And we aren't just speculating that there is demand for this. The transcript provided a massive, undeniable proof point that this strategy is already paying off at the highest possible levels. Management specifically highlighted their recent success in securing a contract with the Israeli Nimbus project.
The Nimbus project is the ultimate validation of this technology. To give the listeners some crucial context, Nimbus is the comprehensive, multi-billion-dollar cloud computing project established by the Israeli government and the Israeli military.
Wow.
It is designed to modernize their entire digital infrastructure. But because of the obvious geopolitical realities, the security requirements for any vendor participating in the Nimbus project are arguably the most stringent and unforgiving in the entire world.
And the transcript explicitly states that the AudioCodes MIAOP solution achieved Nimbus Tier 5 approval.
Achieving Tier 5 certification is not just a regulatory checkbox. It means AudioCodes submitted their entirely localized on-premise AI architecture to the most rigorous, hostile penetration testing and compliance auditing imaginable. And they passed.
That's incredible.
It definitively proves that their on-premise AI solution is robust enough and secure enough to handle the internal communications of national defense apparatuses and highly classified government ministries.
Management noted that because of this Tier 5 certification, they are already securing highly lucrative proof-of-concept engagements across various other government agencies. And the business logic here is incredibly compelling. If AudioCodes can walk into a meeting with a multinational, strictly regulated European bank and say, we have an AI meeting assistant that is secure enough for a defense ministry to run entirely offline, that bank is going to sign the contract immediately.
Oh, absolutely. The GDPR compliance fears vanish. The data privacy concerns vanish.
They noted that the MIAOP platform currently supports U.S. English and Hebrew, reflecting its initial deployment markets, but they are aggressively expanding the capability. The transcript outlined plans to expand the natural language processing to 10 different languages in the first quarter of 2026, and to begin deploying the physical architecture in additional countries by the second quarter.
This is a classic textbook example of judo in the business world. They have taken what the market perceives as their greatest weakness, the fact that they are historically tied to legacy, physical, on-premise hardware environments, and they have flipped it into a massive, impenetrable, competitive moat in the AI era.
It really is.
A pure, shiny, cloud-native AI startup founded 6 months ago literally cannot compete for these massive government or financial contracts. They do not have the physical hardware expertise, the legacy routing knowledge, or the architecture to run their models fully offline. AudioCodes does.
It is a phenomenal strategic pivot. But having a great strategy and having a profitable business are two very different things. This brings us to the critical question of timing. We know they have a stable 93% legacy business. We know they are burning $10 million a year to grow a highly specialized, highly secure AI business at 50% quarter over quarter.
Right.
But if I am an investor holding shares of AUDC, I cannot fund that $10 million burn rate forever. I need to know when the crossover happens. I need to know when the investment pays off.
And that brings us to the forward-looking statements in the transcript. We need to look closely at management's guidance for 2026, and more importantly, their explicit promises for the long-term vision of the company.
Okay, let's start with the immediate horizon. What are they projecting for the full year of 2026?
For 2026, management is guiding for total revenue to land somewhere between $247 million and $255 million.
So compared to the $245.6 million they brought in during 2025, they are projecting a return to clear, albeit modest, top-line growth. They believe the stabilization of the legacy business will hold, and the rapid growth of the AI business will start to meaningfully pull the overall revenue number upward.
Yes.
What about profitability? What are they guiding for the bottom line?
They are projecting a non-GAAP EPS for 2026 of 60 cents to $0.75.
If we compare that to the $1.61 EPS they just delivered for 2025, that tells a very specific story. It means 2026 is going to be another year of absorbing the massive costs of the AI investment. They are essentially telling investors to expect to tread water on profitability for another 12 months. The $10 million burn rate is going to continue suppressing the earnings.
Yeah. If you are looking for an immediate, massive spike in net income, you are going to be disappointed. However, management is actively trying to redirect the market's attention away from short-term EPS and toward a completely different metric, a metric that fundamentally changes how a company is valued.
And what is that?
They want investors to focus on annual recurring revenue, or ARR.
We need to explain why ARR is the holy grail for technology investors. It is the lifeblood of the modern software as a service, or SaaS, business model. Historically, AudioCodes sold hardware. A hospital buys a $50,000 piece of routing equipment. AudioCodes recognizes that revenue once. To make that same $50,000 next year, AudioCodes has to find a brand new hospital to sell a brand new box to.
Right, it's exhausting.
It is a grueling, cyclical, unpredictable way to make money.
And Wall Street hates unpredictability. That is why hardware companies are often assigned very low valuation multiples. The market might only value a hardware company at 1 or 2 times its total annual sales, but ARR changes the math entirely. ARR represents predictable, contractual, subscription-based income. When AudioCodes signs a 60-month managed service contract with an AI software overlay, that revenue is locked in and compounds every single year.
Wall Street loves predictability. They love knowing that on January 1st, a certain amount of cash is guaranteed to flow into the business. Because of that certainty, Wall Street will assign massive valuation multiples to ARR. They might value a SaaS company at 5, 10, or even 15 times its annual recurring revenue.
Exactly.
So $1 of SaaS ARR is mathematically worth significantly more to the stock price than $1 of one-off hardware sales.
Precisely. And this is why management's guidance on ARR is the most important number for 2026. The transcript notes that they expect their total ARR, which combines their managed cloud services and their new conversational AI software subscriptions, to jump by a massive 20% in 2026. They are projecting the ARR will reach between $92 million and $98 million.
So they're aggressively building the exact type of revenue that Wall Street rewards with higher stock prices. But they didn't just stop at 2026 guidance.
No, they didn't.
If we connect this ARR growth to the bigger macro picture of the company's transition, we find the most critical commitment made during the entire earnings call. Management essentially drew a line in the sand. They put themselves on what I call the 2-year clock.
The 2-year clock is the absolute crux of the investment thesis. It is the boldest statement the CEO made. Management publicly committed to targeting a sustained 40% to 50% annual growth rate, specifically for the voice AI segment over the next several years. Remember, that segment exited 2025 at a run rate of nearly $17 million. Management is officially, publicly, aiming to hit $50 million in voice AI revenue by the year 2028.
Growing a nascent software segment from $17 million to $50 million in a highly competitive market is incredibly ambitious. But the revenue target isn't actually the most important part of that 2-year clock. The most important promise is regarding profitability.
Exactly. They stated unequivocally that this specific cash-burning AI segment, the exact segment, currently eating a $10 million hole in their balance sheet every single year, will cross the threshold and reach break even in exactly 2 years.
That is a remarkably specific, highly dangerous promise for a CEO to make on a recorded earnings call with institutional analysts listening. You do not say 2 years casually.
No, you don't.
You only make that promise if your internal financial models are showing a very clear, mathematically inevitable intersection where the exponential curve of the subscription revenue finally overtakes the massive fixed costs of the R&D and the sales teams.
It demonstrates immense internal confidence. They are looking their investors directly in the eye and saying, look, we know the bottom line looks compressed right now. We know the $1 16 EPS is painful, but give us 24 months. In 24 months, we project the 93% legacy business will still be stable, and the AI business will officially shift from being a massive financial drag to becoming a self-sustaining, high-margin engine of pure profit.
They are asking for patience, but they are providing a highly specific deadline for when that patience will be rewarded. Now, before we render a final verdict on this transcript, it is worth noting the only specific, quantifiable headwind that management really acknowledged for 2026.
Right.
During the Q&A session at the end of the call, an analyst specifically asked about the impact of international tariffs.
Tariffs are an inescapable reality for any company that relies on complex global supply chains to manufacture physical hardware components. Management was very transparent. They noted that tariff-related costs negatively impacted the company by about $2.7 million in 2025. Looking forward, they projected a slightly improved, but still significant, $2.3 million negative impact from tariffs in 2026.
So it is a known friction point in their supply chain. It is a geopolitical reality they have to absorb. But contextually, a $2.3 million headwind against a projected $250 million in total revenue is manageable.
Yeah, it's not a deal breaker.
Right. It is an annoyance. It slightly compresses the margin, but it does not fundamentally derail the massive software transition thesis we have been discussing.
No, the thesis remains completely intact. The tariffs are just the cost of doing business in the current environment.
So we have systematically dismantled this earnings call. We have gone through the Q4 numbers, the engineered drop in EPS, the stabilization of the legacy hardware bucket, the massive expansion into the Microsoft Teams and Cisco WebEx ecosystems, the critical pivot toward on-premise, secure AI with the Nimbus project, and the bold 2-year clock promising profitability.
That's a lot of ground.
It is. Which brings us to the ultimate question, the bottom line. So, what does this all mean? If I am a retail investor listening to this deep dive while driving to work, and I am sitting on shares of AUDC, or I am thinking about adding it to my portfolio, how should I ultimately interpret this transcript?
Well, if we synthesize all the conflicting signals we have unpacked today, the final verdict here is cautiously bullish, but only for a very specific type of investor. It is a bullish signal for the patient, long-term investor who understands the mechanics of a corporate pivot. However, it is likely a hold or even a wait and see for a short-term trader looking for immediate momentum.
Walk us through the specific logic behind that verdict. Start with the bullish case.
The bullish case rests entirely on the fact that the biggest, most terrifying existential risk to the company has been mitigated. Over the last 2 years, the fear was that the 93% legacy hardware business was going to enter a terminal, unrecoverable decline before the AI business was ready to support the company.
Right.
This transcript proves that fear was unfounded. The bleeding is stopped, the legacy business is stabilized, and it is generating a highly reliable, incredibly efficient 14% operating margin. That legacy business provides a solid concrete floor under the stock. It provides the safety net.
And what about the growth narrative?
The growth narrative is validated by the contracts. The aggressive 50% fourth quarter growth in the voice AI segment is not a statistical fluke or the law of small numbers. The multi-year, complex managed service contracts with behemoths like AT&T and massive European manufacturers prove they have achieved real, undeniable product market fit.
They're actually doing it.
Exactly. They aren't just selling a glossy PowerPoint vision of AI. They are selling highly secure, specialized software that major regulated institutions are actively deploying today.
But the caution, the reason this might be a hold for a short-term trader comes entirely from the timeline, the 2-year clock.
Exactly. If you buy or hold AUDC stock today, you are making a highly specific, high-stakes bet on management's ability to execute perfectly over the next 24 months. You are betting that they can flawlessly execute their strategy and scale that AI segment to the break-even point before the legacy connectivity market faces another macroeconomic shock or a fundamental technological erosion.
It is a high-wire act. The risk is that the stock might just trade sideways for the next year. The overall EPS is going to remain compressed by that $10 million R&D burn rate. The market might ignore the underlying progress because the headline profit numbers still look weak.
But if you possess the patience to endure that sideways trading, the potential payoff is a fundamental re-rating of the company. If management actually crosses that break-even threshold in 2028, and they suddenly have $50 million in high-margin, highly predictable AI recurring revenue dropping straight to the bottom line, Wall Street will stop valuing AudioCodes like a stagnant hardware vendor and start valuing it like a high-growth SaaS platform.
And then the valuation multiple expands.
Exactly. The valuation multiple expands and the stock price reacts accordingly.
It is a classic high-stakes transition play. You are essentially getting paid a very modest dividend. Management did mention maintaining a 20-cent per share dividend to wait patiently while the executive team completely rebuilds the engine of the airplane while it is currently flying at 30,000 feet. It is dangerous, it is expensive, but if they pull it off, the new engine is vastly superior to the old one.
I think that perfectly encapsulates the risk and the reward of the current valuation.
I want to leave you with a final provocative thought that builds on one specific, incredibly powerful quote from the AudioCodes CEO during this call. When he was defending their aggressive AI strategy, he directly challenged a massive, unquestioned assumption that is currently driving the entire technology market.
Oh, this was a great moment.
He told the analysts, "I see here in the market an assumption that AI value comes from the model. True, the large language model matters. However, the durable value comes from orchestration, security, integration, and governance."
That statement is such a profound, contrarian insight into the reality of enterprise software. It completely rejects the current Silicon Valley narrative.
Think deeply about what he is saying. We are in the middle of a historic gold rush. Everyone is throwing absolute billions of dollars at the companies making the foundation models, the OpenAIs, the Anthropics, the Google Geminis. The market is obsessed with who has the smartest, fastest model. They are the ones forging the pickaxes. But the CEO of AudioCodes is arguing that the real, sticky, long-term financial value for businesses isn't the pickaxe itself. A large language model in isolation is just raw, undirected cognitive power. It is a commodity.
The real value lies in the companies that know how to safely, reliably integrate that raw cognitive power into a highly regulated bank's 20-year-old internal phone system without breaking it.
Exactly. The durable fortunes will be made by the companies building the security checkpoints, the companies building the on-premise governance structures, like the MIAOP system, that actually allow a massive defense ministry to utilize AI without violating international compliance laws or leaking classified data. AudioCodes is betting that eventually the enterprise market will care far less about who built the smartest model and care far more about who can deploy any model safely within their existing complex infrastructure.
It reframes the entire AI investment landscape. It is a question every single technology investor needs to be asking themselves right now as they evaluate their portfolios.
So as you look at the market this week, ask yourself, in this massive AI gold rush, are too many investors completely distracted by the shiny pickaxes? Are we ignoring the reality that the real, durable, generational fortunes might actually be made by the unglamorous companies building the roads, the secure toll booths, and the heavy infrastructure required to actually get the gold out of the mine safely? Thank you for joining us for this Talk Tickers deep dive into AudioCodes. We hope this translated the corporate noise into actionable signal for your portfolio. Keep digging into those primary transcripts, keep questioning the consensus narrative, and most importantly, stay curious. We will catch you on the next deep dive.